Thank you for tuning in, Leverage Addicts. And I'm just going to go over this development deal that is already in the course. The reason why I went unconditional and, I took the move on this, it was purely just a cash flow play and knowing, like, just understanding the fundamentals of this property. So it's like this is in Mount Wellington, which is like very close to one of the busiest mall in Auckland, Sylvia Park. And this piece of land is on terrace apartment zoning. So it's got dual income. So at the time in lockdown, I'm buying it with a 5% cash flow, and interest rate at the time was only around 2.8, I think, 2.8%. So I got 5% cash flow in Auckland in a decent location, and it was a positive cash flow property at the time. So it just made a lot of sense. If I can just lock in the interest rate, even at 3.2% for 3 years, I know I can get through the slumps without worrying about the property too much, if that makes sense. So that's why I made the decision. It was purely understanding the fundamentals, which is, if you guys remember, for the development properties, you've got FFS, which is flat, relatively flat. As you can see here, contour is pretty good. And then you've got free of floodplains, and then you've got services. Now, at the time, like if you look at the site, there's no stormwater on the site. But what I did was I got the property files, and because this property, like this minor dwelling, was relatively new. So I thought about, well, it doesn't have stormwater, but how does it get a minor dwelling? So then we did the property files. We ordered the property files, and we found out that this property has soakage. So that's how they were able to build a minor dwelling. So literally they dug a hole here. You can actually see the stormwater hole here, manhole. So they basically dug a manhole, and then they plugged their stormwater. So what it means, soakage just means that the ground is like good for draining for water, stormwater, because it's volcanic rock. So that's what they already had on site. And so because of that, it made sense, because it's got everything. It was at a very good price. The cash flow was good. So the latest valuation for this property, if I have not shown you guys yet, I'm just going to show you guys right now. So yeah, so this is the current valuation, 2.45 as it is. And then you've got the lot 1 and 2. I'm just going to show you the rough consent so you know what it is. So basically it's 8 lot, and then you've got the 2 bedrooms at 850, and then the 3 bedrooms at 950. And I've just got the building proposal from the construction company. I've got a 1-month quote that I can take. So the costs have gone up significantly than what I intended, and I was really conservative with my costing. So I'm going to show you actual difference of what's happened with this particular site. So this is the actual numbers that you saw inside the course. So what we bought it for was 1.125 million, and then it was an 8-lot subdivision. So the build cost back in the days, like in 2020, was probably closer to like 2,400 per square meter, but I used 2,750. And then the infrastructure cost was much lower as well, right? So if you look at the per lot for subdivision costs, I only use it'll be 7. So around 50K, like that was, no, that's not right. Sorry. It's this one here. Yeah, it's around 120K at the time. That's what I used. Okay. And then you've got your financing costs. So this whole project at the time cost 4 million. That's what I projected in 2020. But the sale price was significantly lower as well. So as you can see, back then I just projected the price to be 650. This is just keeping it within the government, I guess the new build scheme that you can have the government deposit. So I thought, yeah, it shouldn't go lower than that, just because that's where all the new builds are sitting because of the government funding. So at the time, the gross margin was around 28% and the net margin was 20%. So it was a good deal back then. but now the costs have gone up. So what does it look like now? So basically I put this all on a spreadsheet like this to show you guys. So I got quoted for the build costs. This is going to be a fixed price at 3,237. So I know their margin's pretty fat because they're willing to do the fixed price for us. Because this is a relatively bigger developer, I guess, construction company. And so they can lock in the price for the materials. And so as you can see, this is significantly higher than what it was before, which was like my conservative figure was 2,750. Now the cost has gone up to 3,237. Okay. This is the architectural cost and all the engineering costs, like all the engineering report, survey report. I haven't got the cost for the water meter and final approvals yet for the legals and the titles, but I'm just assuming around 5,000. This is based on like the Ashcroft Homes. I guess that's what they quoted me before to get the titles issued. And then these are all the costs quoted, and he believes they will be under what he quoted me. And so these are the actual costing that I got for all of the site works and the infrastructure. It will tally up to around 620,000, including GST. So the other thing that I added in here is a 2% contingency. So just talking to another developer friend, just giving me some advice on the construction proposal, he said, you might want to like do variations on like the, like stuff in the kitchen, like some of the lighting stuff in the end, you might want to upgrade to better stuff. And then also with landscaping, you might end up wanting more and you might spend more money. So he gave me some advice on that and said, hey, look, you better add some margin into your build costs. So he said like at least 50,000, but I just put 2% as around 84. So now you can see my construction cost has gone up to 4.4 million from total cost from 4 million. It went up by 400K, which is around 10%, quite reasonable. I guess like the actual cost has gone up by like 20%. If you saw the construction inflation is around 17%. But because I was more conservative here, like it's only 10% difference. But the great thing about the current market is obviously we have experienced like significant growth in terms of the values. So you can see our proposed values here was 650 and the end value now has gone to 7 million, whereas this was only 5.2 before. But just in saying that though, like about 1 million of this value is just from the land. So the margin actually haven't increased all that much. So I mean, it looks like there's a lot of margin here based on the price that I bought it for. I mean, yeah, I think we're very fortunate to be in this market where the price have gone up significantly. So the construction can start as soon as as short as 3 months, but potentially probably going to be more likely 4 months, because he reckons he needs that amount of time just to make sure that all the materials arrive. So if we look at today's value, so what's going to be different? Like, let's say if you were to do something like this, right? Obviously, potentially construction cost is going to be slightly different. And also the price of the land is going to be significantly different. So I think if you were to buy something like this today, maybe you could potentially buy it for 2.2 million. Okay. But keeping all of the costing exactly the same, you can see if you buy this for 2.2 million, the margin is still around like that 23 and a net margin of around 17%. So you can see it's not too much difference from what it was in 2020, like when we projected. Like we're working with bigger numbers, slightly higher margin, net profit around 540. But because this project is going to be bigger, you need more money. It's 662,000 net profit after all your GST and tax.